Hello and welcome to this video. In this video, we're going to talk about Rishi's latest spring announcement. He's come along with some big changes that's going to affect most businesses out there, especially the sort of business that we look after here at Boffix. Now, one thing we always talk about is how we want small businesses not just survive, but thrive. And I think this statement here really gives some intent on how that could happen. So, strap up and let's have a look into what was announced during the spring announcement, and more importantly, like potential pay rise for all directors out there. This is one not to be missed. Hello, my name is Aaron Patrick. I'm a chartered accountant, a certified UK trainer, that QuickBooks chap on the internet, and also head of accounts here at Boffix. And today we're going to dissect that spring statement that Rishi has just put out there, and we're going to see how that's going to affect you and your small business. So what has happened? By far the biggest announcement that was made was the fact that the actual bands in which you pay your national insurance has actually been increased. Now, that's the good news. The bad news is that was already announced is the fact that we're having an increase in national insurance. So if you remember in the last statement, we were talking about there's that 1.25% levy. Now, national insurance is going to increase by 1.25%. And initially what you'll see is your rates of national insurance will increase to 1.25%. So if you had 7.5% before, it's now going to be 8.75, which is going to be really difficult to calculate. But the idea is that that levy or that element of it, that 1.25%, in the future will be its own different tax band. And then we'll have three different taxes. We will have the new levy, the national insurance, and we'll have income tax bands as well. Now, one of the things to kind of contribute or help on that as much as possible is that we have seen an increase in the actual bands. So the amount of money you can earn before you have to pay national insurance. Now, for a lot of people out there, that's good news. That's going to be an instant tax saving for you, especially for low earners that may even be under the bands that have been announced. But effectively, the idea is that instead of having two different bands, so if you think about it, your personal allowance was always around that £12,500 odd pound, and your national insurance one was around about the £9,000 odd sort of figure. And having two different ones meant that there was that nasty bit where you could pay national insurance, but no personal tax. Now the idea is that they've brought them all into the same threshold. So you'll only have to start paying taxes now if you earn over the £12,500 odd pound. And that's going to be messed around with each and every tax year. Hopefully it's going to be increased and keep increasing. And then the idea is the amount of money that you need to earn before you have to pay taxes, that area will happily increase as well. And that's obviously really, really great news. But the big news is going to be for your directors out there. People who own their own limited company especially if it's only you working for yourself, then having and paying yourself a director salary can be a huge tax saving. And at the end of this video, we're going to look into it a little bit more deeper. We're going to deep dive into it, and we're going to understand exactly how much of a benefit that has been for everyone. So the biggest news from the statements is the national insurance rates are still going up as planned. So every one of the rates will have that 1.25% levy added on. So that's across the board. And also it means that there's going to be the opportunity for us to have more money to be earned before you have to start paying these higher rates of national insurance. So it is a really, really good one. And the one that came in relating to national insurance, and that is the increase in the employment allowance as well. The great thing about the employment allowance being increased means that you can get savings on how much you can actually need to pay over if you do have staff members. Now, originally that was £4,000. That's going to be increased to £5,000. So basically, if you qualify and you're able to get the claim in, then you won't have to pay any taxes regarding your employees until that £4,000 has been utilised. Now £5,000. And that's great news all around. There was also some announcements of big fuel duty changes, effectively trying to reduce the fuel duty that's paid on each and every pence. That has already come into line, so hopefully you've seen the benefit of that. But it was basically trying to prevent as much as possible those increasing fuel prices that we've been all seeing all around. There was also some good news on research and development. So I know a lot of our clients at Boffix who benefit from research and development. They're liking to see these announcements. It's a huge tax saving for certain clients. And the fact that now the restrictions are now for those UK clients only, but there are some exemptions there. But also the good news has been that there is actually some extra costs that you can include that weren't able to be included before. So it's a good news all around on that one. There's also been some news on how much VAT gets paid on certain elements for homeowners. So basically, if you're looking to get solar panels, heat pumps and insulation, then you no longer have to pay the original 5% VAT, the reduced VAT rate. It's now going to be at 0 rate. That's great for homeowners. That means if you are looking to get those installations, then the Chancellor did say that typically you can be saving more than £1,000 on the installation because you don't have to pay that VAT anymore. And then you should be able to get about £300 of annual savings on your energy bills. So it is a really, really good incentive, that one. But for the businesses out there who are installing these heat pumps, solar panels, insulation, then that can be a huge benefit for cash flow as well. Effectively, what that means is that you're going to be charging 0 rate, so that should make your prices more competitive and give you opportunity for you to get more work out. But also, if done correctly, you should be finding yourself getting a potential refund each and every VAT quarter or month, and that's going to be huge for cash flow. If you are charging 0 VAT out there, then you are being charged VAT to be able to provide that service. We can claim all that VAT back, and you'll be in a refund position. So summary of what happened in the spring statement before we look at the nitty gritty bits of how that can affect you. Let's look at the timeline. So first of all, in March 2022, the fuel duty has already been reduced by that 5p per litre. In April 2022, the employment allowance will increase to £5,000. The national insurance will increase by that 1.25%. And then the health and social care levy will become its own separate tax in 2023. And that's when then national insurance reduced back down to its normal percentages. The big one for us is that the lower rates of profits have increased to 11,908. So really close to that 12,500. And the dividend taxes will also increase to 1.25%, which is exactly what has happened to the rest of the national insurance. Remember that there's the 0% now on solar panels, heat and elements and everything else that goes with it. And the VAT on tourism and hospitality returns back to 20% after that reduction of 12.5%. In July 2022, the primary threshold for employee national insurance goes to £12,570. I believe the only reason they've done and delayed that till July 2022 is to give an opportunity for software to be able to be prepared to be updated for these new rates. In April 2023, the temporary increase in annual investment allowance to 1 million will end. So we're going to say goodbye to that 1 million annual investment allowance and it'll be reduced to 200k. So for most of our business out there, that won't be affected. But if you're more of a group structure, that might be something to consider. Corporation tax increases from 19% to 25%. So that's something to be prepared for going forward. That's going to be a really painful area if we're not careful. And we did a whole video on that one. We will continue to look at that and continue to dive into what that means and what options we've got when we come close to that April 2023 deadline. The super deduction, one of our favourite tax reliefs we have at the moment, will also come to an end on that one. So keep an eye out and make sure that you utilise that before that April 2023 date. Again, we did a video on that that you can go to and have a look at. And the lower profits for class 4 and all the other class national insurance contributions will then be right in line with that 12,500 from day one of the tax year, not having the split year that we've got at the moment. Okay, so that's an introduction of what that looked like and everything else. But those national insurance contributions increases are going to be offset by the fact that we're going to have that increase of how much we can earn. One of the biggest takeaways from this is, by the looks of it, it looks like that all directors out there, so you as a director of a business, especially if it's your own business, what we would call a close business, so it's just you and maybe a couple of family members who own it, means that potentially looking like you can get yourself a nice little pay rise that's going to be really, really tax efficient for you. Now, before we look at the numbers, let's just consider why this is important. Well, if you're a director of your own business and you're going to want to be remunerated for the work that you do, remember that a limited company is its own separate entity. So it's going to sit there and it's going to have some income, have some expenses, and then it's going to be taxed at currently 19%. Don't forget that it could raise to 25% in the future, but currently 19%. Then that company then will just continue doing that process year on year on year on year. The problem is that you as a director or a shareholder, which is the most important element of it, wants to be remunerated for that. You want to be paid for that work. You're not doing it as a charity. You probably have a mortgage or a rent to pay or whatever it's going to be. Therefore, you need to take money out of that business. Now, by far the most tax efficient way of doing that is to pay yourself a very low salary so that that salary doesn't incur any national insurance contributions or any personal tax, because they're at quite high rates at the moment, that 20% and the increase that we talked about the extra 1.25% on national insurance, which basically means if you incur taxes on your direct salary, you're going to be less tax efficient going forward. So what we would tend to advise people to do is have that low director salary, which used to be around about £8,500, which used to be just below the actual need for paying national insurance on top. And then you would contribute the rest of your income, the rest of your profits, the rest of the money you need to actually earn to live and to be able to pay your mortgage. We would recommend paying that via dividends. And as long as you've got a profitable business that had profits that could be distributed, then paying dividends is a really tax efficient way. Really low, 7.5%, unfortunately increasing by 1.25% going forward. But still, 7.5 or 8.75% is a really low base of taxes, and that used to be really, really tax efficient. Pay yourself those figures, everyone was happy. But if you think about that director's salary being at 8,500, but your personal allowance being 12,500, we always had a bit of a gap there. And that gap was because of the national insurance threshold being so low. Now that we've got that opportunity though, and rubbing your hands here, now got the opportunity to pay yourself more director salary, gives you an opportunity not only to increase the amount of take-home pay that you can have tax-free, but also reduce the amount of corporation tax. Because if you pay yourself a director's salary, that is a taxable expense in your business. So you get the double whammy of having more money you can take home and reducing that corporation tax bill as well. Okay, so let's look at some numbers and how that works. So first of all, we're going to look at that 2021 to 2022 tax year. So the one that's just gone before these changes happen. I just want to show you kind of exactly what would happen so we can look at comparison. But let's say on this really, really quick comparison idea and just looking at some random numbers here, let's say you had a £50,000 business, you had a one director shareholder, and so it's just yourself. Now, this whole comparison here is about looking at a sole trader versus a limited company. Now, yes, a limited company has two different tax points. You have your corporation tax bill and you have your income tax bill. But as a sole trader, you just have that one income tax bill you have to pay for. And if you think about it, this income tax bill here is primarily just going to be those dividends that you've taken out. Now, as you can see, in 2021-2022, being a limited company was a slight tax saving for you because of the fact that you had £11,125 of tax to pay as a sole trader against £9,910 when you add both of them together. And we look at your take-home pay, slightly increase as well when you were a limited company in terms of how much money you could take home. Now, if we look at this then from 2021 to 2022, you can see that it was quite a significant difference. But if we reduce these down, and let's say that you had £30,000 of profit, well, you had less of a benefit from being a limited company, and it may have been at a point where it wasn't enough of a benefit over the space of a year because of the extra complications of being a limited company that made any sense to you. You did have the ability, and the thing we were always talking about was adding additional shareholders if you can, maybe a spouse or someone like that, because what you'll see is when we add additional shareholders, this figure here, the dividend tax figure, will reduce. The more shareholders you can put in there, the better you can bring down that figure and the more savings you can make there. So that's where we were talking about how you can get some really significant savings. If you could, though, bring on another director, so again, maybe brought on your spouse and paid them, you got some really significant savings. And you could see then that was a massive saving that could be brought in to kind of help it. Technically, you could probably get some nice savings from sole trader as well, but the overall tax bill could come down, which is beautiful. Now, if we move forward, and now remember, £400 basically on a £30,000 profit for 21-22. If we move that to 22-23, split year, so we won't quite get this saving, but you'll see we're jumping up to £900 of savings because that income tax has come down, but also more importantly, your corporation tax bills come down because we've got more money that we can put against it. And it's really given us some benefits there in terms of being able to make the most out of the figures that are there. And then again, if we look even further into the future though, and there's a potential that your personal tax bill will come down to 19%, well, that's when it starts coming back at the other way again, because now we don't have as much income tax to worry about there. But again, if we were able to add in, and I go back to the 2022-23 tax year, if there was an opportunity for us to add more directors, shareholders in there, then we can really see some huge savings there. Again, the sole trader would slowly but surely come down as well. But from a limited company point of view, having that second director, if you just look comparison to comparison, could be a really huge tax saving that's there. Again, it's all about bringing in more shareholders. So the more shareholders we can have, the more we can reduce that potential income tax benefit there as well. And that can be something that is definitely going to be worthwhile to make sure that you can have some significant savings going forward. But basically you can see though that it looks like, on paper at least, that when we move from one tax year to the next, we are going to be seeing some extra income coming our way. And that take-home pay, if we look at what it was in 2021-22, was £2,000, £2,057. Then when we move into the next one, 22-23, looks like we get an extra £100 per month coming your way, which is definitely a good thing all round. Let us know in the comments below if you want us to go through this in even more detail of how these figures come together, what that means for you and everything else. More than happy to do a much more deep dive on, and let us know below if these sort of videos are helpful to you. Hopefully you can see though that certainly this news that we've got about the increase in national insurance has the potential, as long as we start utilising all the allowances we've got, of making sure that our businesses don't just survive but thrive. So we are very much on board with this one. Okay, so that has been me today. Let us know below again if there's any other questions you have on this one, or reach out to us at hello@boffix.com, or book in some meetings with us, whatever works for you. All our links, everything else is all down below. My name's been Patrick. Make sure to like, subscribe, and all that sort of stuff. Let's get as many small businesses out there to understand about this sort of stuff, making sure that they're making the most of their business, making sure they're keeping their tax bill as low as possible, and then let us know below in the comments if there's any other elements you want us to go through. Again, my name's been Patrick. It's been an absolute pleasure to do this video for you. I'm sure I'll see you in the next video. Bye for now.